This is Satya Pradhuman of Cirrus Research. The latest briefing is out, and the title of the report is October Jump Reflects Fed Rally and Year-End Bounce. The bottom line here is that this hope for a seasonal bounce may have passed. When you look at the October data, it's fairly dramatic, and if you put that up against historical comparisons, the fourth quarter gains that should have been seen occurred in one single month. Let's take a look at the data from this report. Here, what you're looking at is these paired bar charts that basically reflect the past and the present. On the left-hand side, what you're looking at are really the market overall performance in down years, and the Russell 2000 version, clearly a more dramatic, higher beta view. But nonetheless, at the heart of this, going back 20, 30 years, we looked at all the periods that the market was weak in the first 9 months, beyond, let's say, a 10% handle. From there, we look to the recovery in the fourth quarter. So basically, what you're looking at is the purple bars represents the longer-term averages. So on average, in a sell-off year, the first 9 months, the S&P was down about 15%. This year, in the blue, they're down 25%. That would imply you should get some sort of a bounce. Historically, we've seen a 6% bounce basically on the S&P. Oh, sorry. Yeah, roughly a 6% bounce on the S&P. This year, just the month of October, we've seen an 8% bounce. And so at the end of the day, the reality is that as we look through this market and we begin to realize that the Fed has really dug in on this idea of fighting inflation, coupled with low unemployment data, gives them a lot of courage. So I think the market's beginning to realize that we're in for a longer run sort of tumult. And at the same time, the Fed has probably really filed in the Greenspan put. The other point here is that leadership continues to break. You've seen the small cap market sell down sharply over the last 12, 18, 24 months. Now what we're witnessing is some sort of a divergence between mega cap growth, like the FANG related names, versus the small value. Russell 2000 small value. So we're starting to see a recovery. I would argue you've started to see some spreads open in the last 3-6 months between smaller firms. This is potentially very constructive in the sense that you're seeing a bottoming of the average stock. We still have a problem, though, with mega cap darlings. And so the benchmarks may suffer as single stocks begin to work. And then finally, the reality of this great division in the tape. It really has a lot to do with this complete reversal from past leadership, healthcare tech, towards commodities. And this chart really says quite a bit about why we are where we are. It is not just an interest rate story. It's also a CapEx story. Take a look at the report. There's lots of important comparison there, including the comparison of active blends and their performance for this year and for the past quarter. Again, if there are any questions, feel free to follow up. Thank you.